I have a question for you. If Warren Buffett were 25 years old today, do you think his favorite tool would be Excel or Reddit? Because the markets have changed a lot. It's no longer the companies themselves that are rising. It's the stories being told about them. It's not economic data that gets priced in. It's the headlines written about companies. And maybe for the first time in financial history, investing has turned from a battle of analysis and information into a battle of attention and narrative. And because of that, maybe we're all playing the wrong game. I think investing has stopped being analysis and turned into a viral reality show. I'm serious. We went from analyzing balance sheets and profitability to refreshing social media every minute wondering who made 500% today. Investing used to be boring, and that was a good thing. There was analysis, there was information, there was something called intrinsic value, and that mattered. But is that still true? Now you see a stock move like a viral TikTok video. Everything happens instantly. Suddenly the story spreads. Everyone is talking about it. Then everyone buys it. And just like that, the price explodes. Did the company actually do anything? Or maybe we don't even know. But the story works. It's entertaining, isn't it? I'll admit, I enjoy it. Watching someone on Reddit turn a weekly options trade into 1000% is entertaining. They post a screenshot. Caption it, "This is just the beginning." The comments roll in. "King, you're built for this." Sometimes I honestly don't know. Is this finance or is this a game? Yes, I'm entertained, but there's also something unsettling about it. Throughout financial history, markets were never perfect. We know that. But at least they were anchored to something real. There were profits, there was cash flow, there was economic data. Yes, there were waves, the large cap craze of the 70s, the dot-com boom of the 2000s, the banking bubble in 2008. But eventually, gravity came back. You can't outrun the numbers forever. They might joke with you for a while. They might entertain you. But eventually, the numbers slam their fist on the table. Sooner or later, the balance sheet says, "I'm still here." But now things might be different. It's not balance sheets slamming their fists anymore. It's trending narratives. In 2020, with the pandemic, many real changes happened. Finance changed too. Maybe it was the pandemic. Maybe social media. Maybe monetary policy. Maybe all of it combined. But something shifted. Millions of new investors entered the markets in a very short time. Liquidity flooded the system. Interest rates were near zero. And that changed the market mindset. The old advice was simple. Buy quality companies at reasonable prices and think long-term. The new advice? Buy the dip. Stocks always go up. And here's the uncomfortable part. That advice worked. It stopped being a strategy. It became a belief. Stocks always go up in the long run. Except now the long run is 2 or 3 weeks. And here's the critical shift. No one is asking, what is this company actually worth? Instead, they're asking, will this stock stay hype? Those are two very different questions. And let me be clear, this isn't just retail behavior. Large professional investors have adapted too. Some seasoned market veterans openly say, the value I calculate doesn't match the value the market assigns. There's a wide gap. And when the market stops behaving the way you were trained to understand it, experience stops being an advantage. It's like trying to navigate a brand new city with an old map. Think about that for a moment. If someone who correctly understood the 2008 crisis says their valuation models no longer align with market prices, how big do you think the disconnect really is? Is that small, or does it mean something deeper? Could it mean that markets are no longer pricing companies, but pricing human behavior and corporate narratives? Behavioral finance has always said one thing: humans are not rational. Psychologically, the pain of losing is stronger than the pleasure of gaining. We follow crowds, we cling to stories. In the past, this was temporary. It showed up during bubbles, then it faded. But what if it's no longer temporary? Social media and the internet have reduced the time between information and reaction to almost zero. A tweet goes out, a YouTube video is posted, a rumor spreads, and within hours, prices move. Stories used to take months, even years, to spread. Now they reach millions in seconds. And eventually, that story turns into a price. A bad story becomes a lower price. A good story becomes a higher price. Institutional investors see this too. They don't just analyze balance sheets anymore, they run sentiment analysis. They track trends, they measure reactions and attention. Because they understand something important. In the short term, prices are driven not by intrinsic value, but by collective emotion. So here's the big question. Is this a bubble? As history shows, markets have gone through psychologically driven bubbles before. And in the end, gravity won. If this is just another bubble, eventually everything will make sense again. But what if it's not? What if the collapse of friction between data and reaction, the power of social media, and the mass influx of new investors have permanently changed market structure and pricing? What if balance sheets and cash flow no longer dominate? And stories and attention do? Maybe intrinsic value is now equal to narrative value. And here's the irony. The more we talk about this, the more you comment. The more videos get shared, the bigger the narrative grows. Maybe it's not capital flows changing markets, maybe it's collective attention. So the real question isn't, why are markets behaving strangely? The real question is this temporary excitement or a permanent structural shift? Is the investment world entering a new era? And if this shift is permanent, then analyzing companies alone won't be enough. We'll have to analyze human nature. We'll have to analyze social media. And the uncomfortable truth? Analyzing human behavior is far more complex than analyzing numbers. Long story short, if this is just a bubble, intrinsic value will win in the end. Gravity will return. But if this is a structural shift, markets will price attention and narrative instead of profitability and debt. And if stories are what get priced, then the rules of the game have changed. At that point, investing won't just be about reading balance sheets. It'll be about reading people. And maybe the real risk isn't prices falling, but continuing to play by old rules in a new game. What do you think? Drop your thoughts in the comments. I'd love to hear where you stand.